Welcome. I hope everyone can hear us. But thanks for joining us for our online first time homebuyer workshop. So this is the first time we're doing this, so bear with us. If you have any questions at all while we are going through this, there's a chat feature. So feel free to jump into there, or you could raise your hand if you want to ask a question while we are going through this. So our hope is to answer all your questions as a first-time home buyer and just kind of give you some tools and help you get started in the process. So I'll introduce myself. I'm Kelly Felix. I'm a mortgage loan originator in the State College office, Center County office. And Scott Gottshall, he will be our Blair County. So Scott, if you want to represent yourself here.
Sure. I'd also like to welcome everybody and thanks for joining us today. I am in Blair County. I'm located, I'm a loan originator. I'm located in our Duncansville office. So welcome and thanks again for joining. So we'll get started. So why Reliance Bank? So I just wanted to talk a little bit about Reliance. We have 8 locations that are both in Blair and Center counties. Although we do loan throughout the whole state of Pennsylvania, we are local. I'll say that again, we're local. This is something that really makes us different than the big banks. We have fast and personalized service. You can always pick up the phone, speak to an originator, or make an appointment to go into one of our 8 locations. We've got several loan options and programs. I think we're going to touch base on those and go into more detail in the upcoming slides. Another great thing that I want to point out is our loan servicing. We have local loan servicing. So after your loan closes, we generally keep your servicing here in Altoona in our downtown office. So when your loan closes, you can always still call, talk to someone about perhaps your tax bill or your payment, but it stays local, and that's a very important thing. Ellen.
So market conditions. Everybody joining this call might be in a different scenario right now. So I don't know if this is your first step of home buying, or if maybe you've already started looking at homes or talked to a realtor. But where we're at right now. So, you know, it's spring, we're in the middle of spring right now. And what are the market conditions? So you may hear a lot of information in the news, or maybe you were even looking last year. I'd have to say our current market is pretty similar to what we dealt with last year. So we're still seeing limited inventory. You're seeing less homes being listed for various reasons. We're still seeing higher home prices. So, you know, we're in a higher rate interest environment as well, which, and with a higher home price, makes it a little bit more difficult. So the more you know, and the more you can be prepared in this market, the better. So how do we do that? We want to make sure we're getting our finances in order. So knowing your credit score. Maybe some of you know your credit score already, maybe not. Sometimes they're giving it to you through your credit cards, Credit Karma. But credit score plays an important part in qualifying for a loan. So we'll help you with that process if you don't already know by pulling credit. Saving for a down payment. So most mortgages are going to require a minimum down payment of 3%. And obviously you can put down more than that, sometimes up to 20% to avoid different things like mortgage insurance. But having that money saved or knowing what we need to save for that. When we're purchasing a home too, there's also closing costs. So typically closing costs can be anywhere from 2% up to 6% of the purchase price. So in addition to that down payment, we just need to be prepared for paying closing costs and what we're going to be aware of what we're going to need. And then identifying assistance programs, which we're going to talk about today. So a lot of times with first-time home buyers, that's very important. We want to know, do we have assistance? Is there any way to help us with the monies that's going to be needed for either down payments or for those closing costs?
Okay, thanks, Kelly. So I want to talk a little bit about special programs and grants that are available sometimes throughout the year. And we actually noticed in some of your comments that you left before the presentation that this is something that a few people are most interested in getting something out of for this during this program. Our first thing I want to talk about is our Freddie Mac Home Possible Loan. And this is probably our most popular first-time home buyer program. So this allows a borrower to put as little as 3% down on their mortgage. So just for instance, to make it easy, if you were purchasing a $100,000 house, you would need to have at least $3,000 to put down on the mortgage. The money can't be borrowed, although you can always get a grant, perhaps from a family, or a grant, I'm sorry, a gift from a family member. So if your grandfather wants to gift you $1,000 and your mom wants to gift you another 1,000, you can use that money towards your down payment. There are income qualifications with this program. And in addition to this, a borrower can apply for a Borrower Smart Grant, where this is down payment assistance. And it is also has income qualifications, as well as where the property is located can also come into play. So, am I frozen?
No, you're still there.
Okay, it looks like I'm frozen. I'm sorry. I have a real funny face that I'm looking at right now. So, two really great programs. The next two, these were available and are no longer available this year, but Reliance Bank, we've always been fortunate throughout the past couple of years to be able to offer the First Front Door program, which is the first one on here. And not all banks have the opportunity to offer this. It is.
You got him out of there?
Yeah, they got your boy then, Jason Kelsey.
Of course. No.
This does have income qualifications. It is for first-time home buyers only. And this grant this year was up to $15,000 in down payment assistance. As I said, that money, it only lasts for a certain period of time, and we usually get notification in March or April that it's when it's going to be available. So it's not available again until 2025, and we can always let you know when that's available. Another program here is the Keys program. This was very new this year. It's the first time ever offered. It is same thing, income qualifications for first-time home buyers. But this also is for first-time home buyers and also minorities and or first-generation home buyers. And this grant is up to $20,000 in down payment assistance. So these are two very, very, very large amount of money that's being offered. Unfortunately, again, this year, they're no longer available. And they hopefully will be available again in 2020.
And I would just say, Scott, too, to point out some of the other, as lenders, we're made aware of other programs throughout the year. There could be some assistance programs within the county. So, we're showing a few of these, but obviously if others come, we would let you know too, exactly what's out there for you to help out.
It's cool.
So first step, we talked about the environment that we're working in right now and how it can be very competitive. You may have your first step may be to meet with a realtor. What a realtor is typically going to say is, hey, before we're going to look at houses, before we're going to do anything, we're going to need to know that you're qualified to purchase this home. So first, what we'll look at is a pre-qualification. So you would meet with a bank, and in this case, Scott or I would help you out to do a pre-qualification. So what we would do here is gather information from you. So we'd be looking at your income information. We would talk with you about, employment, where are you employed? What does your income look like? We would pull credit. So when we pull credit, we're going to pull credit. It's going to be a hard pull from the three major creditors, Experian, Equifax, and TransUnion. That credit check will give us what your FICO score or credit score is, and it'll tell us all the liabilities that you have. So that'll give us a good picture of what you would qualify for. At the time of a pre-qualification, we're not actually collecting documentation from you, so we're not collecting tax documents, but we are going to give you an estimate of how much you can borrow based off of that credit and based off of the information that we've verbally gathered from you. So if a pre-qualification isn't what we need, maybe we need a pre-approval. So a pre-approval is very similar to a pre-qualification, but at this step, we're actually going to collect your documents. So perhaps you're self-employed. Self-employed obviously has a little bit more that goes into that income. So we would be collecting federal tax returns and or business tax returns so that we would know what income that we're working with. We would also collect bank statements, W-2s, any other information that would paint that picture of what we would need to get an approval for you. We're also pulling credit. We're going through those documents and being able to provide you with either a pre-qualification letter or a pre-approval letter. At this point, you have the tools in your hand now that you are going to be more competitive in that market. You'll know what house values you should be looking at, and you're going to know what money you're going to need out of pocket to get ready. But again, in this market, realtors are going to typically want you to have one of these letters in your hands before we even start looking at houses.
So Reliance Bank, I just wanted to mention, we do several types of lending. We have our commercial lending department. We do home equity loans, but of course, you're on this call because this is a first-time home buyer program. We do residential lending. And I just wanted to touch briefly on the types of loans that we do offer. What we've been talking about so far with the Home Possible program, these are conventional mortgages. So they're conventional mortgages through Freddie Mac. We also offer construction loans, and I'm not sure if you've ever really thought about being a first-time home buyer and instead of purchasing a house, possibly building a house. And we do see that a lot. And I hear people say, "Oh my gosh, I hear it's a nightmare to build a house, and just all the problems you go through and all the hassle." And it's actually a very simple process, and we have it down. We do a great construction loan, so that's always something to think about as well. We'll walk you right through the process. In conjunction with the construction loan, we do offer lot loans. So if you wanted to go purchase some ground that you plan to build on next year, we have that option. Not all banks offer a lot loan. And just throwing in there that we do offer fixed rates as well as adjustable rates. I think most people have shied away from adjustable rates because they've heard that that wow, if they go up, I can get into a lot of trouble. But they are coming back right now because they're generally a little bit lower. And perhaps someone would want to take an adjustable rate where it's fixed for 3 years or 5 years, and then would anticipate that they'll probably refinance down the road when and if rates go down a little bit. I just wanted to point out that we do our best here at Reliance to try to find a way and find the product that best fits you, and to try to make the loan work for you. We do have portfolio products where basically it's not a Freddie Mac loan. Just if something might not totally fit the box, but we know it's a good loan, we'll do our best to try to fit it into what product we can.
Perfect. So mortgage application process. So we talked about getting a pre-approval, getting a pre-qualification, and then maybe identifying what type of loan suits you. So mortgage application is really after you have put an offer in on the home and it's been accepted. So what are the next steps there? So we're ready to start the formal mortgage loan application because we've identified the property and we now have a closing date. So at this point is when we would collect all of the necessary documents from you as the borrower, like we said before, W-2s, pay stubs, bank statements. At this point, we're going to have a sales agreement. So we're going to have a signed sales agreement with the buyer, you, and the seller. So we're going to collect that. With that sales agreement, we're going to order an appraisal on the property. So banks are going to require an appraisal on the property. We're going to send an appraiser out to the property, and what they're going to do is do a detailed report for us that would show us comparable sales in the last 6 months, comparable square footage, amenities, so that we know as a bank and that as a buyer that your house is worth what you're paying for it. We would also, at this point during the formal loan application, we'd be ordering title. We'd be working with a title company or a closing attorney to get the title work done and a title search. So the title search is going to be detailed out too to make sure we're showing every time this property transferred hands, we're looking for unpaid liens, defects in title, and that company is providing title insurance to ensure that should anything come up in the future, you're protected as well as the bank is protected at that point.
Okay, so as I've mentioned a couple times, all of our underwriting is done in our Altoona downtown office. You'll notice under underwriting, you see a couple initials here. My wife's in the medical field, and she often comes home and uses abbreviations and terms, and I have no idea what she's talking about. So we kind of do that in underwriting and lending as well. And I'll go over each of these items below. But these are some items that an underwriter is going to look at to determine whether a borrower qualifies for a mortgage. So our first one is what we call DTI, which is your debt to income ratio. And usually we want that ratio 45% or lower. So just as an example, if your gross monthly income is $1,000 and your total bills, including your car loan, your student loans, any credit card debt, come to $450 a month, you are at a 45% debt ratio. So you can kind of do that math at home if you want to try to see where you're at with the debt ratio. We use what's on a credit report. So, typically your cell phone, your electric bill and so forth, that's not on a credit report. So we don't include that for underwriting purposes. The term LTV is loan to value. And that is determined by I'll give an example. If you're buying a house for $100,000 and you put 3% down, your loan to value is 97%. So the minimum LTV is 97. If you're putting 20% down, your loan to value would be 80%. Credit scores. We obviously we're looking at credit scores. Sometimes it can determine what program you're put into or you're eligible for, but it's not always just about credit scores. It's about credit history as well. Because lots of times, if you were to perhaps go and purchase a car, the car dealer might have 10 banks or 15 banks pull your credit. That can really lower your credit score. It doesn't mean you're a bad risk for a loan. So we take all that into consideration. But credit score is definitely looked at. And the last item is PMI, which is private mortgage insurance. And any borrower is going to need to pay private mortgage insurance unless, which is a monthly fee or a monthly cost onto your mortgage payment. Unless you're putting 20% down. So if you're going into the program with 3% down, you're going to have private mortgage insurance, and that's something that's only determined after your loan's put into the system, because it's based on your credit score, your debt to income, and some other factors.
Potential pitfalls. So life happens and we want to chat about that too. So we get the pre-approval or the pre-qualification done for you and you're still in that home buying process or looking at homes. Sometimes things can happen. So sometimes a car can break down and we need to get a new car. But if that happens, that obviously changes the financial picture that you came to us with originally. So we do want to be aware when you're in the home buying process that if you are taking out any new loans or you are taking out any line of credit, that you want to make sure that you let us know that, so that we may need to adjust what you then would qualify for. Maybe we need to lower that loan amount or that house price based on any new debt that came out. Same thing goes with losing a source of income. So if some type of job loss happens, we take a different job and maybe that income changes. Again, we need to be aware of that so that we can work together to make sure we're still doing our due diligence and that you're looking at the home prices that you should be looking at. Large purchases before closing. We've been doing this long enough. We've seen it. We've seen where somebody says, you know what, I got the house, I signed the agreement, and now I'm going to go furnish it. I'm going to buy all my furniture. Well, you might not want to do that prior to closing either. And if you do want to do that, you need to talk to the lender to make sure, hey, I'm going to qualify still with purchasing all this furniture if this is what the monthly payment's going to be. So just making sure that we keep everything in line during the process. And again, life can happen, but we'll just make sure we communicate and work together, and just some things to avoid during the process.
So we just wanted to throw in a couple mortgage calculators or scenarios here for you. And let me point out that when you're in the process of looking for a house and you know the details on it, at any time you can call Kelly and I, and we can do a detailed closing cost worksheet estimate to show you different ideas with seller assist and so forth to show you what the real picture will look like. And we're happy to do that anytime for you and as many times as you need. But this is an example of a 30-year fixed with 3% down. So we have a purchase price of $220, 3% down payment would be $6,600. We threw in an interest rate there of 7.125. Rates can change every day. Rates can change a couple times a day. We've been hovering right around that 7% range. So this is a pretty clear figure of what the payment would be. As I mentioned in my previous slide about mortgage insurance, since you're not putting the 20% down, you would have private mortgage insurance. And again, that's based on a few items. So we pretty much made up that figure of $174. You've got property taxes, and you have your homeowner's insurance. So we're saying here that your estimate monthly payment would be right around or right a little below $2,000.
Scott, I would just say on that too, on the private mortgage insurance, when you do reach a 20% equity, right, and that's going to happen over time with you making principal payments, that private mortgage insurance will come off once you have that 20% equity position. So yes, it gets you into a home because sometimes we just don't have the 20% down. So private mortgage insurance isn't always a horrible thing because it does get you into that home and allows you to, start building that equity, but it will come off after that 20%.
Kelly, I'll add something again too. It makes a difference if you're at 97% loan to value, meaning you're only putting 3% down. That private mortgage insurance is going to be higher than if you were to put 5% down. It does go down, or if you put 10% down, or if you put 15% down, it's a lot lower. So that is determined, like I said, by several things: your loan to value, your credit score comes into play, and your debt to income comes into play.
Yep. Good point. Good point. So the next one we just wanted to show you is very similar to what Scott said. This one's a 30-year fixed now with 20% down. So if you're able to come up with that full 20% down payment, then we wouldn't have mortgage insurance in this scenario. Still looking at a purchase price of $220,000. That down payment's obviously going to increase to $44,000. Property taxes and homeowners insurance. So property taxes and homeowners insurance, we do typically collect as part of the total monthly payment. So this new monthly payment at $1,564, we hold those in what's called escrow, right? So the mortgage company collects them on a monthly basis in your total monthly payment. And when those bills come due every year, we'll make sure we pay those out on your behalf. A lot of people like that because you're not worried about coming up with those property taxes once a year when you're not prepared, because we've been collecting them over the monthly basis. So we just wanted to show you two scenarios. Obviously, there can be a million scenarios. So as Scott said earlier, we're happy to put together any estimates for you as you see houses that you would like. So that kind of sums up, right, what our first-time homebuyer guide is today. So we would open up to any questions or any thoughts that anybody has. Happy to answer anything.
I think we did that good of a job, Kelly.
I think we did. But obviously, if you don't have any questions, or maybe you don't want to ask those questions here, our information I think was in the slides, that you can reach out to us at any time, or pick up the phone and call any one of our Reliance Bank branch offices. Everybody, we always have somebody that's happy to help and happy to answer any questions that you have.
Appreciate you joining today and hope you have a great day.
Thank you.
Thank you.